Dear students, earlier we have learnt about working capital management part 1 consisting of basic concepts and estimation of working capital. Now we will deal with each component of working capital, how it is to be managed. First we will go for inventory management. By inventory we mean the stores of raw material, work in progress, finished goods, spares. We have to manage this inventory properly because once your amount is being blocked in the inventory, the funds are not available for investment elsewhere. As a result, you are foregoing the return which you would have got had you invested this amount. This refers to opportunity cost. And at the same time, you should have proper inventory in order to meet the demands of the customers. Therefore, there is a need for proper management of inventory. The basic objectives of inventory are to see to it that the production is uninterrupted. You should have sufficient amount of raw material so that your production is not affected. Similarly, you should have sufficient amount of finished goods so that you are able to meet the demands of the customers as and when they require. Similarly, when discount is being offered by the suppliers, you should go for purchase of raw material so that you are able to get the benefit of discount. At the same time, carrying cost should be kept low. Carrying cost refers to the storage cost as well as insurance taken on the inventory. If you have more of inventory, carrying cost will be more. So, therefore, you have to reduce this carrying cost and you should prevent loss of revenue. Prevention of loss of revenue refers to involving opportunity cost less. The funds when they are being blocked, the amount not available which would have earned you some return, that return you should not forego. Not foregoing the return means you should have opportunity cost less. These are the objectives of inventory management. For the purpose of having better control over the inventory, you have various techniques. One such technique is levels, maintenance of different levels. You have one level as maximum level. Maximum level refers to that level over and above which you should not have the raw material or finished goods. If you have more of inventory over and above this maximum level, what happens is unnecessary funds gets blocked. So, how are we going to calculate this maximum level? Maximum level calculation depends upon the reorder level and reorder quantity. Reorder level refers to that particular level at which you should place an order of purchase of material. Reorder quantity refers to at a particular level when you are placing an order, what is the quantity which you should have to purchase. So, reorder level plus reorder quantity minus minimum consumption at any point of time per day, what is the minimum consumption multiplied with minimum reorder period. Reorder period refers to the time taken from the time of placing an order till the time of receiving the order. So, that refers to the reorder period. So, minimum reorder period is to be multiplied with. Then another level is minimum level. Minimum level refers to that particular level which has to be maintained at any point of time so that your production is not interrupted. So, reorder level minus normal consumption into normal reorder period would give you minimum level. For this purpose, calculation of maximum level and minimum level, you require reorder level. Reorder level calculation would be maximum consumption multiplied with maximum reorder period. Then average level would be the average of maximum and minimum level. At the same time, this average level can be calculated by taking minimum level into half reorder quantity. Now, let us see how are we going to calculate these levels. Here, you have to calculate minimum, maximum and reorder level. Minimum consumption, maximum consumption is given. Similarly, normal consumption, reorder period 10 to 15 days means 10 is minimum, 15 is maximum. Reorder quantity is given and normal reorder period is given. So, by going with the formula, reorder level would be maximum consumption into maximum reorder period 150 into 15 2250. Minimum stock level would be reorder level what you have calculated here 2250 minus normal consumption is 120, normal reorder period given in the problem is 12 days, you get 810 units. Similarly, now go to the calculation of maximum stock level. Maximum stock level is equal to reorder level which we have already calculated as 2250 plus reorder quantity 1500 given in the problem minus minimum consumption 120 into 10 which is your reorder period will give you 2250. This is how you are going to calculate the levels and you are maintaining these levels, you are not exceeding that particular levels. Another technique available is EOQ, that is economic order quantity. Economic order quantity refers to that quantity which has to be ordered and which is economical. Economical in terms of carrying cost and opportunity cost. More the quantity purchased, your number of orders will be less, as a result of which your ordering cost comes down. Ordering cost refers to the transportation cost and as well as your inspection cost. More the quantity purchased, your ordering cost will be less, but storage cost would be increasing, carrying cost will increase. So, the intersection point of these two will determine what is the economic order quantity which is to be placed, at which the total cost is economical, which is minimum. Any quantity other than the C order quantity EOQ will give you more cost. The same thing can be calculated with the help of a formula. It is root 2AO by C. A refers to the annual requirement, O is ordering cost per order and C is carrying cost per unit. Here you have to calculate EOQ. Annual usage is given as 1,20,000 units. The formula being EOQ root 2AO by C, root 2 into annual requirement 1,20,000 into ordering cost per order. Cost of placing an order is given as 60, take that 60, then divide by carrying cost. Carrying cost, they have given carrying cost is given as 10% of inventory value and purchase price is 10. So, 10% of this 10 rupees will give you 1 rupee, which is carrying cost per unit. When you calculate this, you are going to get 3,795 units. Then another technique is perpetual inventory control. This technique consists of maintaining the records, that is bin card and stores ledger, and recording both the receipts and issues. In case of bin card, this is being maintained by the storekeeper. He is going to maintain only the quantity received, quantity issued and what is the balance quantity, chronological order. Similarly, stores ledger will be maintaining all this, but also the receipt at what price you have received and also issue at what price you have issued. Then the balance, not only the quantity but also value will be maintained. This will be maintained by the cost accountant. The stores ledger and bin card are being maintained by two different persons, so that there is automatic check made by one person. The work done by one person is automatically checked by the other person. The quantity which is recorded in the bin card, the balance should tally with what balance is being shown in the stores ledger. Then stock turnover ratio gives you how fast the stock is being turning over in the organization. Greater the stock turnover, greater can be the inventory of that particular material. Stock turnover would be cost of raw material consumed divided by average stock. Now, another technique is weight classification. V is vital, that means whatever material is considered to be vital, that should be maintained adequately. E is essential, the essential material will be maintained sparingly, and whatever is desirable, even if it is not there, does not matter, therefore you dispense with. Then another technique available is FSN classification. FSN classification refers to fast moving stock, slow moving stock and non moving stock. Fast moving stock will be maintained in adequate quantity, slow moving sparingly and non moving will be dispensed with. These are the various techniques which are available to the management for the purpose of proper management of inventory. Now, let us go to the next component, that is your receivables management. When are you going to have receivables? When you sell goods on credit basis, you are going to have debtors. That debtors are considered to be your receivables. Receivables refers to amount due from the persons to whom you have sold goods. The main objective of this receivable management is to have optimum sales. Unless you sell goods on credit basis, your sales will not be increasing. So, in order to have more sales, you may have to sell goods on credit basis. But what happens is, when you are selling goods on credit basis, you have both costs and benefits. This costs and benefits, you should make a trade off. The various costs which are incurred in case of receivables management are your opportunity cost. That means, the amount when you have sold goods on credit basis, the goods value has been passed on to the customer, but have you received the amount? You have not yet received the amount. Had this amount been available with you, you would have invested somewhere, you would have got a return, that return you are foregoing, and that is what is considered to be your opportunity cost. Another cost with regard to receivables is administration cost. You have to maintain the accounts of the debtors and continuously monitor them. So, this involves administration cost, and you have to appoint persons in order to collect the amount from the debtors, involving collection costs. And once you sold goods on credit basis, that means you are running a risk. The risk is the debtors may pay you the amount, may not pay you. If they are not paying you, then it results in bad debts. So, these are the costs which are incurred when you sell goods on credit basis. Similarly, now let us see as to what are the benefits we are going to get when we are selling goods on credit basis. Sales will increase. In order to face the competition, you have to sell goods on credit basis, as a result of which your sales are going to increase. As a result, your profit also will increase. Profit will increase because sales minus total cost. Total cost consists of variable cost and fixed cost. Variable cost only will be varying with the sales, but your fixed cost remains constant. Because of the element of fixed nature of fixed cost, your profit will be increasing when sales will increase. So, you have to make a trade off between cost and benefit and see whether you have to sell goods on credit basis or not. If so, how much you have to sell on credit basis. Now let us see the credit policy. You can have a tight policy or loose policy, but you should neither have a too tight policy nor a very loose policy, but there should be an optimum level of credit policy. Here tight policy refers to you are selling goods on credit basis to whoever comes to you. That means without verifying their credit worthiness, you are selling them goods on credit basis, you are offering more discount, you are selling on credit to a greater extent and for a longer period. All this refers to the loose policy. If you go for tight policy, you are selling goods on credit basis only when their credit worthiness is proved, but you should neither sell on loose policy nor on a tight policy, but an optimum policy is to be maintained. What is this optimum policy? Optimum policy is a trade-off between liquidity and profitability. When you are selling goods on credit basis, your profits will increase because sales are increasing. But what happens to the liquidity? Liquidity comes down because amount is blocked in the form of receivables, in the form of debtors. The intersection of these two curves, profitability and liquidity curve, will determine the optimum credit policy. Now let us see the aspects of credit policy. The various aspects of credit policy are, first one, credit terms. When you refer to credit terms, normally they give you like this, 2 by 10 net 30. 30 means 30 refers to the credit period. Within 30 days they have to make the payment of the amount, and 2 by 10 refers to 2% discount will be offered if they are paying the amount within 10 days. If they are not paying within 10 days, they have to pay by 30th day, which is the credit period. This 2% discount will be available only when it is paid within 10 days. This is what is your credit terms, and credit standards refers to character, capacity and condition. Character is the willingness of the customer to pay the amount, and capacity is the ability of the debtor to pay the amount, and conditions refers to the general conditions, in the sense that if the firm is having more of raw material or more of finished goods, in such a case what happens is it will sell goods on more favorable terms to the debtors. Then credit analysis. Before giving credit to the customers, you have to analyze the credit. If he is a new customer, then you have to ask him for giving the bank statements and references. If he is already an old customer, then you can see from the past records how the payment was, whether he is to pay on time and whether he is to be very prompt or not. So that is what credit analysis is to be made, and then you have to design a proper collection policy so that the amount is not blocked with the debtors. Now let us see how we are going to calculate the benefit and cost and see whether a particular policy is to be followed or not. Earlier, let us say annual sales were 30 lakhs and collection period was 36 days. Now the management wants to increase from 36 days to 60 days the collection period. That means they want to extend credit from 36 days to 60 days. That means they are going towards the loose policy. Whether this policy is to be adopted or not, we have to make a decision. Now because of loose policy, sales are going to increase by 25%, selling price is 10, 7 rupees is variable cost, contribution per unit would be 3 rupees, fixed cost remains constant, so we need not have to worry about the fixed cost. Then rate of return is 25%, whether increase in collection period is appropriate or not, you have to make a decision. In order to make a decision, we will see what is the benefit first we are arriving by going to a loose policy. Earlier sales were 3000 followed by 3 zeros. In the new policy, because of increase by 25%, sales are 3750. Now coming to the contribution. Contribution is 3 rupees per unit. Earlier sales were 3 lakh units. 3 lakh units into 3 rupees, you will get 900 followed by 3 zeros. Now your sales are 3750. Now multiply with the contribution per unit, you will get 1125 as contribution. Additional contribution is 2,25,000. This is the benefit you are going to get. Now we will see what is the cost. Cost can be your opportunity cost, bad debt cost, then collection charges. Collection charges are not given in the problem, bad debts are not given. Now we will see how much is the opportunity cost, how much funds are being blocked over there. First we have to calculate accounts receivable. Accounts receivable calculation would be total sales or total cost if total cost is given. Total sales are 3000 divided by debtors turnover. Debtors turnover would be number of days in year 360 divide by the collection period which is being given as 36 days. So, 360 divided by 36 is 10, 3000 divided by 10 would be a 3 lakhs. This 3000 is followed by 3 zeros. Now, coming to the new policy, your sales are 3750 followed by 3 zeros divided by, now the collection period is 60. So, 360 divided by 60 is 6. When you calculate this, you are going to get 6,25,000. Earlier debtors were 3 lakhs, now it is 6,25,000. That means your additional investment in the debtors is 3,25,000. This refers to blocking of funds. Because the funds are blocked to the extent of 3,25,000, the return which you would have earned is you are not able to earn. That involves opportunity cost. Opportunity cost is 3,25,000 which is there with the debtors, multiply with the rate of return which you are foregoing, which comes to 81,250. Your additional benefit is 2,25,000, that is additional contribution, and additional cost is 81,250. As benefit is more than the cost, accept the policy. That means you can go for increasing the collection period. This is how you are going to make the decision. Now, the last factor, last thing in this receivables is factoring. Here receivables, when you have debtors, instead of you having the botheration of collecting the amount from debtors, you can entrust this job to a particular person specialized known as factor. When the seller sells the goods to the buyer, seller will send an invoice to the factor. Then factor will advance amount to the selling firm and later factor will collect the amount from the buyer. After collecting the amount from the buyer on the due date, factor will send the full amount final payment to the selling firm. So, this is what is factoring. Instead of you collecting the amount, you are entrusting this task to the specialized agency known as factor. Now, we will go for the cash management. Cash management refers to the management of cash in a proper way, so that you are not blocking up funds, because cash is idle cash which earns you nothing. If you invest this cash somewhere else, you will get a return. Therefore, you should not have much of cash. The various facets of cash management are cash planning. In the initial stage, what you do is you plan for a short period. You prepare a budget. You are going to estimate what are the receipts and what are the payments. You are making this budget because you will know what is the surplus cash with you or the deficit. If you have deficit, you can go for arranging for loan, and if you are having surplus cash, you can think of various avenues where you can invest this cash. Therefore, preparation of budget is a must in case of cash management. Now, coming to the next point, you are going to manage the cash flows. How are you going to manage the cash flows? Cash flows refers to cash inflows and cash outflows. You have to accelerate cash inflows. If you want to get something, you have to get as early as possible, if possible today itself. So, you have to accelerate cash inflows and decelerate cash outflows. Decelerating cash outflows means you are going to delay the payment, so that you have a cushion, you have cash with you which you can invest somewhere else and earn some return. How are you going to accelerate cash inflows? There are two systems, lockbox system and concentration banking system. When you say lockbox system, instead of the head office collecting the amount, what you do is at different branches you are going to hire a post box and ask the customers to directly deposit their checks in the lockbox. Local bank branch is being advised to collect the mail several times, so that the amount is being deposited in the bank directly, so that you are saving in processing time as well as the mailing time. And another system is concentration banking. Concentration banking is you are going to set up collection centers at different branches depending upon the volume of transactions, and the duty of collection centers is to collect the amount from the customers and deposit in the local branch, bank branch, and then send the information to the head office stating as to what is the amount being collected. So, this is how you are going to save time in collecting the amount, both processing and mailing time. Whereas, coming to the deceleration of cash outflows, you are not going to make the payment, you are asking the head office to make the payment, and the payment will be made not in cash but by check. So, you are saving some time, so that cash is available for you which can be used for some other purpose. Then you have to maintain an optimum cash balance. Optimum cash balance, here you are going to take two costs, transaction cost and opportunity cost. When you have more of cash, when your cash balance is more, what happens is your opportunity cost curve will increase, because if this cash, instead of keeping idle with you, had it been invested, you would have got a return, that return you are foregoing. this is what refers to the opportunity cost. So, more the cash balance, more the opportunity cost. But another cost which is the transaction cost. Transaction cost means you should not forego a transaction because of not having cash. If you have cash balance more, your transaction cost comes down. So, the intersection of transaction cost and opportunity cost will determine optimum cash balance. If your cash balance is more than the optimum cash balance, what you have to do is you have to make investment of this extra amount in marketable securities, because this excess cash balance is for a short period. Therefore, you have to make investment in short term avenues. So, one factor which has to be taken into consideration when you are making investment is safety. Safety with regard to your principal amount as well as the interest amount. And then another aspect is liquidity. Whenever you are in need of cash, you should be in a position to sell away these marketable securities and get the cash. So, that refers to the liquidity. Maturity. When you are making investment, it should be for a short period, because you are having extra cash only for a short period, hence investment also should be made for a short term. In case your cash balance is less than the optimum cash balance, make arrangement for borrowing, so that you are having cash which is necessary and which is optimum. You should have neither more nor less. Now, let us see how to prepare the cash budget. In order to prepare the cash budget, it is similar to your cash account, receipts and payments. Instead of having receipts and payments in an account form, you are going to have in a statement form. In the initial stages, you are going to take the receipt, add up the total receipts, then take the payments, add up the total payments. Receipts minus payments give you the closing cash balance. Closing cash balance of 1 month becomes the opening cash balance for the next month. If you are having a positive cash balance, if your receipts are more than the payments, it means that you have sufficient cash. If your receipts are less than the payments, then make arrangement for borrowing. Let us see by an example. For example, sales are 72,097 and 86. For 3 months, sales figures are given, purchases are given, wages, production overhead, office expenses, and the assumptions are cash in hand. 1st June is 72,500, then 50% of sales are cash sales. Fixed assets are purchased in the month of July. Debtors, when you sell goods on credit basis, you are going to give a period of 1 month credit, and creditors 1 month. Sales commission is 3% on sales. From this problem, let us see how to prepare the cash budget. First, we will talk about the receipts. For 3 months, in the receipts, how you have opening cash balance, you are going to start opening cash balance for the month of June. Then for July and August, we are going to get later. June closing balance becomes the opening balance for July. July closing balance becomes the opening balance for August. Now, coming to the cash sales. In receipts, you have 2 types of sales. One is cash sale, one is credit sale. Cash sale is given as 50%. Take June sale, multiply with 50%. Take July sale, multiply with 50%, you are going to get cash sale amount for the month of July. Similarly, for August, take total sales, multiply with 50%, you get cash sales for the month of August. Now, coming to the credit sales. Credit period, you are going to give 1 month. That means, last month's sales you are going to receive now. How much you are going to receive? Only 50%, because credit sales are 50%. So, for the month of June, this is the starting period. So, last month for June, May figures are not given. So, we cannot calculate for June. For the month of July, take 1 month back, because credit is 1 month. Take 1 month back, take June sale, multiply with 50%, you will get the amount collected from debtors. Similarly, for the month of August, July sale, multiply with 50%, you are going to get for the month of debtors. Add up the receipts, you get the total receipts for June, July and August. Now, let us go for payments. When we come to payments, creditors, when you purchase material on credit basis, you are going to have creditors. Credit period is 1 month. So, for the month of June, you are going to take 1 month back. 1 month is a credit, therefore, take 1 month back. So, for the month of June, May purchases are not given. So, we cannot calculate for June. For the month of July, take June purchases, full will be paid in July. July purchases will be paid in August. Now, coming to commission, commission is given as 3%. Calculate, take sales of each month, June, July and August, calculate 3%, we are going to get commission for each month. Wages, production overhead, office expenses, as given, they have not given any credit. So, each month expenditure is paid in the same month. Now, coming to the fixed assets are purchased in the month of July. So, take for the month of July. Add up the payments, you get the total payments. We have already calculated receipts. Now, receipts minus payments is 84,840 for the month of June, which is the closing balance, which becomes the opening balance for the month of July. for the month of July, we are going to get the opening balance 84,840. Now add the receipts of July minus the payments of July, we get the closing balance for the month of July, which becomes the opening balance for the month of August. Add the receipts of August and then payments of August minus, you are going to get the closing balance. So, this is how you are going to prepare the cash budget. Thus, you are going to manage the total working capital components properly, so that there will not be any problem. You will not be unnecessarily blocking your funds in these particular things. You are going to make a trade-off between the profitability and liquidity. Okay, we got the closing balance for the month of August 1,42,150. Here all the closing balances are positive figures. In case it is a negative, it means that payments are exceeding the receipts. In such a case, we have to make arrangement with the bankers in order to borrow from them. If you have surplus, you can as well repay the loan which you have taken. Now let us recapitulate what we have done. First, we should know what we mean by working capital, then the basic concepts, gross working capital, net working capital, and how to determine the working capital requirements, both in terms of total working capital as well as component wise. The different components we have already seen are inventory, cash and receivables. There should be a proper management of all these aspects, receivables, inventory and cash. Otherwise, what happens is your funds gets blocked here. Therefore, you will be involving an opportunity cost. At the same time, if you sell goods on credit basis, your profits will increase. Therefore, you have to make a trade-off between liquidity and profitability and have a proper management of all components of working capital. These working capital, when you have to finance, you have both the sources, long term and short term. Short term sources are for a short period, but the cost in case of short term sources is less, whereas long term sources, it is for a long period, as a result of which interest charged on the long term sources will be high. So, from the cost point of view, short term sources are better, but you will be getting long term sources for a long period. From the risk point of view, long term sources are better, because you need not have to worry that you have to all the time you have to go for renewal, you need not have to worry about it. So, you have to make a trade-off between long term sources and short term sources, which sources should be used for financing a particular type of working capital. Hardcore working capital and temporary working capital. Hardcore working capital and fixed assets for a long period, therefore match with the long term sources. Short term working capital, that is temporary working capital, is for a short period, therefore match it with short term sources. So, that is how you are going to make financing of working capital. Walker has stated about the different aspects which should be taken into consideration for the purpose of determining the working capital. He says working capital level depends upon the risk perception of the management, the attitude of management towards risk. If the management does not want to take risk, if the management wants to take risk, then naturally you can go for less working capital, but if you do not want to take risk, go for more working capital. That is how working capital will be estimated.